Hey everybody, I'm Dave Putz from JKP Holdings. Alongside me, as always, Mr. Nathan Turner.
Hello, hello.
Hey, hey, Mr. Nathan. So you're traveling again, which is always good, right? So I'm really excited to get together with you today. One thing cool is we got to hang out together just last week at the Node Expo. For those who didn't know, in Dallas was really, really awesome. It was exciting to meet people we haven't seen in a while, connect with people new, and we made some really good connections. For those who weren't there, you missed out on a good time. So Nathan, what do
All,
you think about what you
all about
saw? Yeah,
it's all about going to conferences. It's so important, and we've talked about that a lot of times, but it can't be overstated. It's so important out there, get in front of people, talk face to face,
yeah,
go grab dinner, whatever. It's a big deal
yeah,
difference.
yeah. And it gives credibility, right? People who may see you posting on social media and then seeing you in person and actually having that conversation is night and day for a lot of people. It just gives you the ability to network really, truly in person, right? So one thing we found, or I found at the conference, was this idea of people weren't ready for the next stage with note investing. I think we found a lot of people who didn't know what a bid calculator was and didn't know how to evaluate non-performing notes, who are only doing performing notes. And
Yeah,
we both know performing notes are only going to be around for a short period of time. We're expecting everything going to change quickly
yeah.
in the coming days. Yeah,
Yeah, anytime you're looking at performing, it's always with the thought this might go non-performing,
yeah,
and if that's going to happen eventually at some to know how to deal with it. So it's
sure.
really important to know both sides of business.
Absolutely. I totally agree with you. As you can see, Nathan's traveling a little bit, so bear with his audio video. Hopefully we'll be able to stay on with us the whole time. When we talk about this stuff, one of the things we are very intrigued with is this idea of that the notes are going to be shifting soon, and we're expecting that. Nathan and I are be running our infamous 5-week note class starting back in January. If you are interested, feel free to go to our website, reach out to us about that. We'll be starting January 9th. For those who are not sure about it, take a look at the website. We teach how to build a bid calculator on there, a non-performing and performing bid calculator. We talk about due diligence, and it's a serious class for those who want to get to the next level. It's a really, really, really necessary process in your note development to get to the next stage, to actually have a non-performing calculator that includes things like statute limitations and next due dates and foreclosure timelines and costs, because those things will kill you if you don't have them figured out. So, so
Yeah,
Nathan, what were some of your takeaways that you learned from the Node Expo that may have, those who didn't go, they need to understand, or so they attend next one?
uh, there was a really good session with some bigger note investors. So you had Chaz on there, you had Yanel, Bill Pymel, and Chris from Kirkland,
Yeah,
and it was a really great panel. I where we're going to be causing our next recession,
yeah,
and it seemed like the was that affordability was going to be the thing. And
yeah.
my own personal opinion, I think it's going to be a combination of affordability and commercial crash, where people
Good
are
point.
not able to keep up with their. So I think it's going to be a combination of those two things that leads us into the next wave, and we're going to see much more of these defaulted paper coming our way.
Absolutely, I agree with you. So let's get into the thick of things. One of the things that came up really, really popular in the last couple of weeks was this idea of reverse mortgages, right? Outside the seller finance world, which we've been focused a lot on, and we're going to continue to focus on originations and seller finance, is this idea of this reverse mortgages. And I would definitely stay tuned in for the ending because Randy's going to tell us about a lot of his successes and failures in that space, right? Because Randy's done more than just reverse mortgages. He's been a note investor for years. And we want to hear at the end what is his best situation and worst situation he's been through in the note space. So stay tuned in for that. I've met Randy through social media and at conferences, and it's great and necessity to connect with others who are experienced because you learn from each other on a daily basis. And I think that if you don't do that on a regular basis, you're going to get behind.
Totally agree. Yeah, you need to know all the different options there. Just learn a few, pick one and do one at a time, but know what the other options are.
Absolutely. So we're going to let, I know Nathan's struggling with some audio and that's okay. We can at least see his pretty face. And let's bring in our guest, Randy, on to the conversation. Randy's been in notes for a long time, but before I introduce him, let him introduce himself. Randy, welcome to our show. Share a little bit about your background. How did you get into the note space? How did you learn about notes? And what brought you into this world that we all enjoy?
Wow. Yeah. I mean, back in 2008 timeframe, I actually quit my job, my corporate job that I had for 18 years in 2008. And everybody's telling me, you're crazy. You're going to go into real estate now. And truthfully, I didn't have a crystal ball, so I felt a little lucky, but really just got into initially just buying houses and, the traditional fix and flip or mainly creative real estate buying with subject to lease option owner finance. And then in 2000, roughly 11, I heard about notes, probably at a conference or something. I just heard a little bit about it, started digging a little bit more. And really jumped into it full time around 2011, 2012, and started buying notes. So I think about my first note in 2011.
Okay.
And it's been great ever since.
Wow.
Great business.
That's awesome. It's so cool to hear from other people who are doing it for a regular business for this long. So did you get formalized training? How did you become successful?
Yeah, so I learned, the first notes I bought were really performing notes that I was trying to buy maybe in my IRA or 401k or something like that. And kind of learned a little bit during that process. And when I was buying those notes at the time, they were giving like a guarantee, meaning if the note stopped performing, they would buy the note back, less the payments you received. So I thought, how can I lose, right? So I jumped into it. And then I really started learning by, looking at the note, the mortgage, the assignment. What do you have to do to actually buy the note, the purchase and sale agreement, the loan sale agreement, whatever you want to call it. So I really kind of got my feet wet there. But then there's a lot more layers, right? I mean, The note investing space is really, I wouldn't want to say difficult, but if you don't have someone to help you, it's nothing that's really intuitive. You have to, you pretty much your attorneys are helping you or you get mentored by somebody. I got a lot of mentoring through PPR, for example. So back then I was buying notes from them. They had a little bit of a course and some mentorship type stuff. So I really learned a ton through those guys. So that was really, really great. So that's really where I learned most of my note investing.
Gotcha. Gotcha. Yeah, they've been in this space for a long, long time. It's really cool to have a full circle. So you've been in the space as long as we have, plus what you've seen in the last couple of years is probably a lot different than you saw for the first 10 years of in the space. Can you tell us a little bit about that?
Yeah, it's really changed. I mean, starting off buying notes. No, again, let's say we just talk about non-performing notes. Buying non-performing notes at 35, 40, 45 cents to the dollar. Back in 2011, even 2011, because you think about it, when the market came down, it really didn't bottom until 2010.
You're right.
And then kind of hovered around and started kind of trickling up a little bit, but still the notes were still selling at a definite discount. And then it just kept going up and up and up and up. And then, you know, I was always saying, okay, 65%, that's going to be it. I'm never going to go past that. And then now we're kind of, you know, past that. So you really have to do your due diligence because
Yep.
you can get in trouble, right? You buy
Yeah.
something and, you know, unless you have an exit strategy that's going to work, you could end up negative. So I was always very probably conservative, probably like you guys. And I always made sure it's going to work. Nothing's 100% in this business.
Sure.
But if you really look into it and really do your due diligence and, you know, look at a couple exits, maybe it's going to be exiting through the house, through the homeowner. You know, maybe if you get it back, what happens? Can you fix it up? If you rented it, if you had to rent it, can you make money? So you have to look at every aspect of it. But
Absolutely.
yeah, the notes are, you know, still a good business, but you have to really, it's a kind of more of a diamond in the rough right now in terms of the NPLs, but that'll change.
Yeah.
It'll change. But
Yeah.
there's still some out there.
Yeah, absolutely. And I think for us, it became a different world because people got used to this performing world that just is just unique. I don't think I bought my first performing note the 2019. It just wasn't available, or was available, but it wasn't priced well enough because non-performers were killing in the pricing.
Right.
We're getting huge double digit returns, 40, 50%. We get modifications and restatements and stuff like that. But things have shifted a lot in the last 3 years. What do you think's been the biggest shift in the market because of what's going on?
Yeah, I mean, over time, a lot of it's just that the sheer inventory from 2008, 9, you know, is starting to, you know, obviously get used up and depleted. But also, you know, just a shift in values, right? When the values go up on houses, the values go up on the notes. And as everybody knows, even before the COVID happened, the values of the notes in the houses, and the notes was going slowly up. But then when the COVID hit, it really got more difficult. So
yeah,
now we're in a situation, you know, in my opinion, that you know, house prices are at such a high level with the high interest rates that we're seeing a lot of people that get it under contract and then it falls out of escrow, right? So if I have a house right now, this is a separate business, but you know, buying a house subject to, it's in escrow, and then it fell through. This guy had it 3 times. It happened to him. So guess what? They're really motivated now. They have to move, and they've seen that this person couldn't get a loan. That's going to happen more and more. So that's going to produce more inventory of NPLs and so on for everyone.
Yeah.
So, you know, it's going to take some time, but it'll get there.
Yeah, absolutely. I think for us, the non-performing world is something we got comfortable with, and the performing world got get boring. And how you calculate performing versus not performing are 2 different animals. I think people are going to have to really learn how to bid on assets that are performing today that will most likely default in the future. And they just don't know how to do that. And they really need to learn that. But we wanted to learn more about this idea of, and I just got a question before we went live, is reverse mortgages. Are you creating them? Tell us about, why are we talking about reverse mortgages? Are you creating reverse mortgages, or are you doing something different with them, like buying them?
Gotcha. Yeah, I'm definitely not creating them. I'm not a originator. Never will be, probably. You know, God bless those people, but that's not what I do. So basically, just a few clarifications about what reverse mortgages are, things to know about reverse mortgages, so we're kind of on, you know, the same page. So the first thing is, there's private reverse mortgages, and then there's HUD reverse mortgages. When you hear the word HECM loan, that is a HUD product, meaning it's a HUD underwritten product. So HECM stands for Home Equity Conversion Mortgage. So those are reverse mortgages that we buy, and you know, typically the exits through the house because the people are usually deceased. The house is usually vacant, but sometimes we sell them at the auction. Sometimes it goes to sale, and then sometimes we get it back and we either rent it, fix it up and rent it, or just sell it outright. So the other thing I think everyone should kind of know about reverse mortgages is, you know, so less important, I guess, on a reverse mortgage that's HUD backed, a HECM loan, the people can take the money and use it for anything.
Okay.
The
Yep.
private one that they necessarily can't do that. But again, that's kind of not super important. The other thing is HUD requires the lenders to assign the loans to them once the person reaches LTV of 95%. Okay, so that's why you'll see a lot of times on these things that, you know, there's 2 notes and 2 mortgages.
Ooh.
Okay, so that's one of the major, you know, people ask, what's the differences? Well, that's one of the differences. So there's 2 mortgages and 2 notes, or 2 deeds of trust and 2 notes. Why? Because the HUD wants to make sure that once the lender can't put any more, and they get that they have to start making the payments, then they have security, right?
Mm-hmm.
So that's one thing you definitely want to remember.
So this idea of reverse mortgages is literally the borrower reversing the process of making payments, but instead of that, the borrower is getting payments up to an agreed amount, and they're collecting income from their equity of their house.
Right. Yeah. I guess I should explain the basics of it.
It's all good.
I get a lot of times I assume stuff, but bottom line is, yeah, I mean, reverse mortgage, either 1 or 3 things happens. 1, they get a big lump sum of money because they have equity. Let's say they have a house that's free and clear, they got a $200,000 house and they get a lump sum of 100 grand, or they get payments over time, or they do like a line of credit. That's pretty popular one.